You've spotted a textbook bull flag on GBP USD. The RSI is oversold, the trend line is holding, and the news cycle is quiet. You hit buy, only to watch the trade instantly reverse. Your stop loss is hit in seconds. You followed the indicators perfectly, leaving you to wonder why a setup that looked so certain failed so quickly. This happens when you trade in a vacuum. By analyzing a single currency pair in isolation, you ignore the global forces driving the other half of that pair, the greenback. Nearly 80% of all Forex trades involve the US dollar. To understand its movement, traders look to the US dollar index, or DXY, the market's invisible hand that dictates the direction of global capital. Checking the DXY before you enter a trade is the step that separates speculative guessing from a strategy aligned with the flow of global liquidity. The DXY tracks the value of the US dollar against a basket of 6 major world currencies using a geometric weighted average. This basket is heavily skewed toward a single player. The euro holds a 57.6% share, driving the index's movement. Because the euro dominates, the DXY acts as an inverse mirror to the USD-USD pair, with a correlation of nearly 90%. Other currencies, like the Japanese yen and British pound, make up the rest. When you see a breakout on the DXY, you are seeing the collective failure of these currencies to hold their ground against the dollar. Understanding this mathematical tilt allows you to see a rising DXY for what it often is, a reflection of Eurozone weakness. This insight helps you avoid false breakouts on pairs that aren't actually tied to the dollar's strength. To predict where the index is heading, you must look at the underlying current moving it, U.S. interest rates, specifically the 10-year Treasury yield. There is a symbiotic correlation between the two. When U.S. yields rise, investors buy dollars to access better returns on government debt, pushing the DXY higher. The Federal Open Market Committee is the ultimate driver of these yields. When the FOMC shifts its policy stance, it can spark dollar trends that persist for months at a time. If the DXY breaks through a technical level while Treasury yields remain stagnant, the move lacks its fundamental engine. These are the high-risk setups that often lead to fakeouts. This creates a paradox. The US dollar often surges when the American economy is booming, but it also spikes when the global economy is in a state of collapse. Economist Stephen Jen explains this through the dollar smile theory. On the left side of the smile, global fear drives investors to the dollar as a safe haven, regardless of what happens with interest rates. The bottom of the smile represents economic mediocrity. When the U.S. economy is stagnant and the Fed is cutting rates, the dollar weakens, creating the ideal environment for long positions on foreign pairs like the pound or the Australian dollar. On the right side of the smile, the U.S. economy outperforms the rest of the world. Capital flows back into U.S. assets, driving the DXY higher once again. Identifying which phase of the smile we are in tells you whether to hunt for risk-on setups or prepare for a risk-off surge. To use the DXY as a master filter, follow one rule. Never trade a USD pair without first verifying the index's location at a major support or resistance zone. This applies to commodities like gold, which are inherently priced in dollars. A DXY rejection at a resistance level often serves as the green light for a long position on XAUUSD. This chart illustrates SMT Divergence. While the DXY makes a higher high, the euro refuses to drop, forming a higher low. This exhaustion signals the euro is holding its ground, pointing to an imminent reversal and potential rally. Mastering these divergences moves the DXY from the background of your analysis into a precise leading indicator for identifying high-probability market turns. Trading the dollar index as a master filter provides the bridge between retail chart reading and understanding professional capital flows. Before your next entry, ask yourself if the dollar index gives you permission to take the setup. If the index and the pair are out of sync, the best trade is often no trade at all. Open your charts now and overlay the DXY with your favorite USD pair. Review the last 3 major moves and see if an SMT divergence preceded the reversal. To trade with institutional-grade technology and 0.0 pip spreads, join the NX1 community and subscribe to the FXNX weekly macro brief. Learning to filter noise through the lens of the dollar index allows you to align your trades with the momentum of the global market.